Good day and welcome to FinChat Podcast, where we interview professionals in the finance industry to allow them to share their experience and knowledge and to educate and expose the next generation of business people and entrepreneurs to the world of finance, banking and related topics. I am Joshua Prince, and here at FinChat we recognize experience in business as a resource to learn from, and we try to harness that resource as best as possible. Today we're back with the second part of our real estate investment series with Attacq CEO Hamman. If you missed the previous episode where we discussed his journey to becoming CEO of a JSE listed real estate investment trust, go check it out. It was a very insightful conversation. Also make sure to check out the FinChat Instagram page for bite-sized technical infographics to help you understand the lingo a bit better. Today we're going into the technicals of real estate investment, which I believe is going to be really informative. But with no further ado, Hamman, welcome to FinChat.
Thanks, Joshua. Thanks for hosting me.
So in the previous episode, you also mentioned your change over or the listing of Attacq, and that you joined on as a result of the experience that you got from your being the chief risk officer at Westbank. Can you please go into a bit more depth about what was the governance and things, the key role you played in that process?
Okay, it's a good question. And it's not Attacq specific. I think from a principal viewpoint, if you are operating as an unlisted company and then you would like to go through the transition process of being listed, there's a lot of boxes that you have to tick. So the boxes will be from a JSE rule viewpoint, but it will also be putting governance structures in place. And I'm just going to give you one simple example. So the first decision we have to make even prior to the listing, it also talks to King 4. So, I mean, if you're unlisted, King 4 is not that applicable, because if you're unlisted, also most of the time your shareholders of management and management are shareholders. So it's not that you as management has a duty to look after the shareholders' interest because you are a shareholder. So I think to some extent, operating in a private environment, to some extent, it's easier than in the listed environment. So going into the listed space, when we said, okay, there's King 4, there's the Companies Act, but you will always apply to the Companies Act. So let's say there's King 4 and JSE rules. We went through a checklist and said, okay, where do we have our gaps? Then, for instance, on King 4, where we have had the gap is on your internal audit function. So then we had to make the decision, do we say, or do we implement internal audit, yes or no? Because if you go back, and at that point it was King 3. So King 3 had sort of the guideline, you can either adapt or explain. So we could have said no to internal audit, but then we have to explain to shareholders why don't we have an internal audit function. So then we said, okay, now it makes sense if we do have an internal audit function. Then the second question is that function internalized or externalized? When you said, you know what, we're so small, we've got only 40 people, let's have an externalized internal audit function. And then we've appointed one of the big 4 firms as internal auditors. And it's now 7 years later, and they are still our internal auditors. So I think and then you can also talk about audit committees. Again, from a listed space viewpoint, you need to have an audit and risk committee meeting. They need to sit once per quarter. And again, it's a King 4 requirement, where in the unlisted space, I think most of the unlisted companies, especially the smaller unlisted companies, they won't have the internal audit committee, or they won't have a transformation committee, or not even a remuneration committee.
Oh, yeah, that makes sense.
Remuneration committee. So there's a lot of committees that we had to put in place. And then each one of those committees, we had to articulate the charter or terms of reference. You need to put a mandate in place. So there was a lot of, call it, like you said, processes, policies, procedures that we had to put in place to enable us to list.
That makes sense. And obviously there were also all the shareholding requirements. I think we learned in our finance classes about the amount of public shareholding and all those other things that you need to comply with as well.
Exactly. I think that to that extent it was a bit easier for us because we were public but unlisted. So we already had quite a shareholder base. And I think in layman terms, we refer to you as you're trading OTC. So you're trading over the counter. So fortunately for us, like some of the structures were in place, but not all the structures. So those structures we had to put in place to enable us to list.
And just for interesting, when you trade over the counter, where do you actually buy and sell the shares? Do you just find other shareholders?
Yeah, or you can talk to the company secretary. So Soraya used to do some of those trades, but she will rather implement the trade. I mean, the buying and the selling, it's more between a buyer and the seller. So we will not negotiate the prices on your behalf, and then she did the transfers for us.
Oh, that's so interesting. I never really knew that's how it worked. But then going on, in May 2017, Attacq converted from a property company into a real estate investment trust. First off, what's the difference between the two, and why did you decide to do that conversion?
It's a good question. So we've initially listed as a capital growth fund. So what we have said to shareholders, we're not going to pay our dividends. What we will do with the dividends, we will reinvest the dividends into the company. And as you know, that one of our core assets is the development just south of Allendale in Waterfall, where it's a Mall of Africa. Now there's also the head offices of PwC and Deloitte. So what we said, we're not going to pay our dividends. We're going to use the dividends, put back into our developments, and then the benefit for you as shareholder is that we will keep on growing, we will keep on developing. And then we've made the decision to convert to a REIT. Now a REIT, like you said, it's a real estate investment trust. A REIT's got a couple of criteria that it needs to adhere to be listed as a REIT. So I'm going to mention a couple of them. So for one is you must have a minimum asset base of 300 million rand, which is not a lot. I think when we've converted to a REIT, our asset base was north of 25 billion. So that was not an issue. The second criteria is that your loan to value, or call it your gearing levels, must be less than 60%.
Yeah. Do you need to maintain that?
No, you have to. Okay.
Okay.
And then your third criteria is, your third criteria is that you have to pay to shareholders at least 75%. And then they link the JSE rule to the Tax Act. So they say at least 75% of your taxable income, or we use the word distributable earnings. Okay, so, and then from a shareholder viewpoint, if you do invest in a REIT, the REIT doesn't distribute a dividend per se, it distributes what we call a distribution. And then you as an individual, you have to pay full income tax on that distribution. Where on a dividend, it's a 20% withholding, and then it's to some extent tax-free in your own name. So with a REIT, that is not the case. So
yes, I remember from class they see it as rental, so that it's like rental income to a
exactly.
normal
So that's
person.
why if you look at the REITs from an income yield viewpoint, the REIT will give you quite an attractive yield. But if you're an individual, let's say you're in the highest tax bracket, then you're going to pay 45% tax on that attractive income yield.
Okay, so who do you think would be then the best people to invest in REITs? Is it mostly like just normal human being, like people who don't earn max tax bracket?
I would say yes and no. I mean, up until COVID-19, the REIT gave you quite an attractive, sustainable yield. So I think if you're a shareholder, you are looking for sustainable income. And the rationale for that is because rental income like I said, up until COVID-19, was fairly stable. And then on top of that, and that's why people preferred a REIT, let's say above something like a government bond, or call it money market money, is that on an annual basis, in theory, you should get an escalation on the previous year's distribution, and that's on the back of your rental escalations. So I would say up until now, it was fairly consistent, sustainable distribution flow to our shareholders. But if you talk about tax, and I'm going to give you a bit of tax advice, and hopefully SARS will not listen to this conversation. But for instance, if you look at myself, I mean, a lot of remuneration to senior management sits in your share options. And so what I've done with all my share options, I've donated it to my wife, and there's no donation tax between spouses. And then all the distributions is then taxed in her own name. So, so I think the effective tax rate is like 10 or 11%.
Oh, okay, that's a lot better.
If it was in my name, I would have paid 45%. The fact that it sits in my wife's name, we're paying 11% tax. So it's not an issue.
So in the past, a REIT has been effectively almost like a very low nominal value to own property that yields rental income.
I'm going to oversimplify a REIT's income statement. So let's say a REIT's rental income is 100. Then, and this is called it the average REIT, and most of us do have the same percentages. Then your direct property cost is about 55% of 100. And that direct property cost is rates and taxes, water and lights. We also use the word soft services that talks about landscaping, security. It's whatever you have to spend to maintain and operate that specific property. So when it's 100 less 55, then you sit with, we use the word NOI, a net operating income of 65. Then there's quite an important ratio in the life of a REIT. We call it the ICR, your interest cover ratio. So on average, it's better than a 2, but to make my calculation a bit easier, I'm going to use 2. So you sit with a 65 NOI, then you pay your interest to the bank of 32.5, and then you sit with a distributable earnings of 32.5, and then you will pay that away to your shareholders. So that's the normal, typical business model of a REIT. And then every 6 months, we will pay away our distributable earnings.
Oh, okay. Obviously, every 6 months you give a dividend. And in a REIT can own almost any property, because when I did some research on REITs, I found that some REITs, I don't know in South Africa, but abroad, they own even like cell towers, and they own servers and all these things. If you look at, they even own.
Let's maybe talk closer to home, and then we can maybe talk to something like the States. So I would say there's different asset classes from a real estate or property viewpoint, and call it your retail, which is your shopping centers. Then it's offices, it's industrial. Now industrial, you can split between heavy industrial, which is the manufacturing plant, or light industrial, which is warehouses. And then it is some REITs, but not a lot, do have residential units. I think in the States they refer to its apartments. And then, so if you look at SA, and if you look at the REITs currently listed on the JSE, I think there's about 35 of the REITs. Some of the REITs are specialized. So if you take a high prop and the L2D, they specialize due to the fact that 95% of their portfolio is retail only. Then there's Equitas, that's also listed on the JSE. 100% of their portfolio is focused on warehousing or light industrial. Then I would say most of the REITs, including us, do have a diversified portfolio. So if you look at our portfolio from a rental income viewpoint, it's split 50% retail. And then included in that retail is, for instance, Linwood Bridge, Glenfair, a stake in Brooklyn Mall, Garden Route Mall, Eikersstad Mall, Mooirivier Mall, and then Mall of Africa. So that's 50% of our rental income. And then 50% sits in industrial offices. And then we've got 2 hotels. Also quite interesting, coming back to the States. So in the States, there's, I would say, more focus from the REITs viewpoint. There's, for instance, REITs that will only invest into data centers, which currently in SA it's not the case. Or there's REITs that's 100% focused in the hotel industry, which we don't have in SA. So I would say in SA, we've got a number of REITs that are focused, but most of the REITs do have a diversified portfolio.
I guess also in SA, it's because we almost have a limited market. So to actually have a sizable portfolio, you can't really focus too much on one thing, because then your portfolio would be not quite small.
You're 100%. But from an asset manager and an investor's viewpoint, and it's also in the States, it's not, we'll call it globally, not only in SA, the industrial portfolio, which talks to your warehouses, it's actually the preferred asset class currently by investors. So that's why if you look at the REITs and if you look at our market prices versus our NAV, I think Equitas is one of the only ones that's currently trading at a premium to its NAV.
Sure, that's very interesting.
Just the rationale that it talks to what will your tenant base, how will the tenant base react during different cycles in the economy? And then they say the industrial warehouses will always be quite a strong sector, regardless of what's happening to the economy.
Yeah, I mean, if you have things to store and can't sell it, you always have to
exactly, and that's what
keep
we also
on
say.
using
what
it.
has happened now with COVID-19 is, I can remember in my student days, we've used the term a JIT system, just in time, from a stock system viewpoint. And they said now, due to the fact that people are battling to get stock into SA, people will, to some extent, move away from JIT, and they will hold more stock to cater for events like this. And I think that's also one of the reasons why, call it, warehouses are currently the flavor of the day.
Yeah, no, that makes sense. So going a bit more into the technical finance, talk us a bit through about when you see our investment opportunity or a development opportunity, how do you go about it? How do you obtain the financing? And what are the key critical success factor of a property investment, even holding it or before you buy it?
Good question. So for us, and it's not only for us, it's for any investor, he talks about total return. And total return is a function of your capital growth and then your income yield or your income growth. So when you buy any asset, then you must look at the combination of what's going to happen to your capital value and what's going to happen to your future income. If you, for instance, would like to purchase, call it a standalone office block, then you will do a lot of work on the tenant or tenants in that block. Because at the end of the day, you are not only buying the bricks and mortar, you're also buying the underlying lease agreement. Yeah. So the purchase price will then depend on, I would say, one, the quantitative value of that lease, and then qualitatively, how strong is the underlying credit of your tenant. So what we normally do, and it also talks to valuation principles, we will follow a DCF model, a discounted cash flow model, and then we will present value, PV back, the value of that lease agreement. So if it's a 2-year lease with, let's say, a AAA rated tenant versus a 10-year lease with the same tenant, you will pay more for the 10-year lease than for the 2-year lease. So long story short, what we will do, we will look at total return, we look at the quality of that income you are purchasing. Then from a bricks and mortar viewpoint, you would look at the specific property, what's happening, we use the word node, or what's happening in that, call it, area around that property. How good is your access into the property, access from, let's say, the highway? Is it easy to get access? So I think it talks about, in the olden days, they said when you need to buy a house, it's location, location, location. And that's still to some extent important when you buy even any type of property, residential, commercial, retail offices.
Yeah,
And then
that
once
makes
you
sense.
come to the
And then,
purchase price, you will reach out to the banks to obtain funding. And that's currently one of the challenges in SA. And what is the challenge is you will buy a property, we call it a yield, let's say a yield of 9%. So your yield is just your income return. And now pre-COVID prime interest rate was sitting at 10.25, and I think it's now 8.25 or 7.75. So that difference between your property yield and your bank funding it's fairly small. If you go to a country or call it a region like Eastern Europe, you can buy properties at a 7, 8, 9% yield, and you can obtain bank funding at a 2 or 3 or 4% yield. And that's also, so you've got a nice spread between your property yield and your funding yield. And that's also the reason why a number of SA REITs, including us, have invested into either Europe or into the States or into Australia. Because, like I said, in SA, your difference between your property yield and your bank funding rate, it's quite slim.
Yeah, that's quite scary actually to think about, especially for property, because like you said previously, the risk is quite low, the business risk, so you could gear up your financing a bit more, and having a high cost of capital with relating to your debt makes it difficult to obtain higher spread in South Africa.
Exactly.
In a REIT.
So that is one of the challenges for us.
Okay. So, and you said what you normally expect in South Africa is a yield of 9%.
Again, it depends on property to property. I mean, if it's a quality retail asset, then some of those yields are sitting between 6.5%, 7.5%.
And it's the same in the rest of the world also.
For instance, in the UK now, pre-COVID, you would have purchased a quality property at a 4% yield. But then you must remember their prime was sitting at 1.5%. Yeah, so you must also look at your yield versus, call it prime interest versus your bank funding.
That makes sense. And then I remember when I was at your results presentation, you had a couple of joint ventures with other companies. What is the motive behind that?
I would say it's twofold. Initially, prior to the listing, we entered into a JV because we were short on capital, and then our JV partner provided capital for us. So what we've done, and that was in Waterfall, we've sold 50% of the land to the partner, and then we did the deal 50-50. Okay, so that's one reason you're looking for capital.
Yeah.
A second reason is, let's say you've got a piece of land, you want to build a building, and then call it person Y will come to you and say, listen, I've secured this 10-year lease. Are you interested in doing a JV on your land? We will also say yes. I mean, we sometimes say tongue in the cheek, it's better to have 50% of a development than 100% of a piece of vacant land.
Yes, okay, that makes sense. So it's to get capital and to employ your assets that you have also. Fantastic, Mel. I think that makes it for this episode.
You're welcome.
Thank you.
Thanks for listening to this FinChat. Remember, we learn from repetition, so please share with your friends and have discussions around what you've learned. And we'd love to hear your thoughts and recommendations, so write to us and give us a follow on LinkedIn. You've been listening to FinChat Podcast. I am Joshua Prince. Until next time, goodbye.